Do not do this with your cash. Please don't do this. It doesn't make any sense. You're taking on way too much risk for a minimum reward. And I'll share what I'm talking about. All right, so a couple things when it comes to financial planning as you're transitioning into retirement. We're getting away from the accumulation phase, which is where we're trying to get growth. Now we're trying to set it up where we have money that we can draw on in a safe way without having to sell stocks, for instance, when they're down 25 to 35%. We don't want that. That's why I recommend always having 3 years, 2 to 3 years, 3 years ideally, of cash on the side. That way you can tap into it. You don't have to worry about the stock market. And typically, if the market falls within 3 years, it's kind of come back to even, maybe a little bit above, maybe a little bit below. But you're not selling at the bottom, March 9th of 2009, for instance. You're not. You're saying, hey, October 2007 comes around, I got enough cash to last the 2008, 2009, and 2010. And by the end of 2010 that came around, I'm probably pretty much back to where I was. Now, there's no guarantee that'll happen in the future, but intuitively it makes sense. I don't want to sell on March 9th, 2009. I think the Dow at that point is down to 6,200 now. All right, so that's a big deal. You can't have that. So you keep 3 years of cash. Now, what people always say, well, what do you mean by cash? And what I mean by is savings accounts, high-yielding money market accounts, and CDs. So let me share what I'm talking about. So right now, you can go to Navy Federal Credit Union. Oh, don't forget the 4 S's. Smash the like button, subscribe, share the video if you want to support, and then, of course, say your comments down below. So I looked at Navy Federal, and right now they got a cash account. Navy Fed, we'll just write here. Navy. Why can I draw that? Hold on. Jeez Louise. My mind is drawn. Navy. Can't draw the right Navy to save my life. All right, so right now their cash account and a share certificate was, I think it was 1.25. All right, that's a completely liquid account. Then they have a 1-year CD at 2.4. They got a 17-month CD at 3.2. All right. So let's just say you got $60,000 for simplicity, and we're going to say we're going to divide that up into $60,000, and we're going to say we're going to divide that up into 3 years. We just need $20,000 a year. We got $20,000 from Social Security. We need $20,000 a year to live on $40,000 a year, just for simplicity. So $60K, and so we need $40K a year to live on. Does that make sense? Social Security provides us $20,000 of those $40K a year. So now the rest we're going to take out of cash. So we're going to put $20,000 here, $20,000 here, $20,000 there. All right. So what does that give us? Our trusty calculator. We can see that the 17 month. We're going to say that's a 2-year CD just for simplicity because it's such a good deal. So actually, that 17-month CD at Navy Fed is better than 2 month. You just got to check on occasion, see what kind of rates you can get for a bonus rate, if you will. So anyway, that $20,000 at 3.2% is going to give us $640. All right, so $640. That $20,000 at 2.4% will give us what, $440, $480. Yeah, $480. At $20,000 at 1.25% will give us $250. So we add all these up, and after the end of, we're going to get each year. At the end of the first year, we'll get $1,370 of interest. All right, with me so far? No risk, nothing fancy. We got 3 years covered. 3 years of cash covered. First year, second year, third year. All right, so we're done. We got 3 years covered. We don't have to worry about stocks. We don't have to worry about anything. Now, some people say, but Josh, you can squeeze more out of your account. Let's see if I can't. Yeah, I guess I'm already there. By investing in a bond fund. So I went online to look at the Vanguard. I think the Vanguard total, I'll tell you what, what's VBMFX. Yeah, you can see that. That right now is paying 2.72% interest. All right, so I had people all the time say, well, I want to get more. This isn't enough. That's not even being the rate of inflation. I want to get more bang for the buck than what I can get on CDs and savings accounts. That's okay. So now we're going to put all $60,000 in this guy right here at 2.72%. And that's going to give us 60,000 times 2.72%. That's going to give us $1,632 of interest. All right? So we take these two difference, 1,632 minus 1,370, and this gives us all of $262 more. $262 more. Now, the Vanguard Total Bond Index, I'm just using this as a proxy because you certainly don't want to get corporate. I mean, well, you don't want much in corporate bonds. You don't want much in long-term bonds. You want to keep the volatility as minimal as possible. But so you're getting on the Vanguard Total Bond Index, about 70% of that is Treasury bonds, all right? So there's very, I don't want to say low volatility, pretty low volatility. Guaranteed bonds. I mean, you can't get a safer investment than a government bond. So this right here is a pretty good option for what we're trying to do, which is to say, well, I want to get a little bit more bang for my buck than CDs and savings accounts, so I'm going to go to the bond fund. And you're like, well, I can net another $262. Is that so? First and foremost, 262. Really? Is that worth it? No, it's not. I mean, that's $20 a month. It's, no, not even $20. Yeah, about $20 a month. I mean, come on. But I get the point. You say, well, what if I do something more? But look, the problem with this guy is if you look in from, let's see, I'll grab this purple. Oh, that was purple right there. Let me grab blue. If you look at this bond fund did on January 1, 2018, it was at 1072 a share. Yeah, okay. On November 11th, 2018, it was at 1022 a share. A 50-cent difference. If we take 50 cents, we divide by the initial price, 0.5 divided by 10.72, the fund itself was down 4.66%. All right, so basically we might have got 2.72% as a yield, but we lost 4.66% on the capital depreciation. We lost money because of the value of the net asset value, the price per share dropped by more than the yield. So in this case, we actually were down 4.66 minus 2.72, 1.94%. So we're down 1.94% is what we lost for that year. So now we made $262 more in interest, but we're down 1.94% in terms of the total appreciate or the total value of the account. And what we can quickly factor in is $60,000 minus 4.66%. We were down to $57,204. So we start with 60, it was $57,204 because we're taking the interest out. And even with the interest thrown back in there, we're still at a net loss for the year because we add the interest to that, and we're still underwater. So we lost $2,800 of principal, but we gained $1,600 of interest. We're down $1,200. That's $100 a month, right? Yeah, $100 a month. Don't do that. All right. So we lost $100 a month in order to gain $20 a month higher interest. That doesn't make any sense. I mean, don't do that. And this is a less risky situation here. Now, what happened was, the reason this happened is because the Fed was raising. And we know for a fact the Fed raised, 4 or 5 times last year. When the Feds raise, the price of bonds goes down. And so people say all the time, well, what if I don't know, they'll say, what if I do, I keep it in cash and wait for the Fed to raise and I can buy the interest rates? Look, forget all that. Get the mindset out of accumulating assets. Get the mindset on how to protect your downside risk. We're in a decumulation phase at retirement. We need to protect the bottom line. You got to get the mindset out. Accumulation is what we've been trained. We got to get the best bang for a buck, best bang for a buck, best bang for a buck. When you transition to pulling that out, you got to look differently. You got to say, look, at the end of the day, this $60,000 needs to be there for my 3-year time frame, so that way I don't have to touch the market when it falls like a brick in water. I can let it be. That'll give me more of a peace of mind so I can sleep at night. That'll also allow my stocks to grow without taking money from them, and taking money from stocks in a down market is a kiss of death. And on top of that, I can use a compounding interest because if stocks do grow, I'll be able to use the growth of stocks to replace this right here when the markets go down. There were bond funds, my friends, that got hammered in 2008. Corporate bond funds did. This is a government bond predominantly. I mean, again, 70% is going to be government bonds, all right? And so because of that, this isn't that risky. But the question is, why stretch for yield, or what's called reach for yield? Why do that? The more you reach for yield, the more likely you are going to have downside risk, like right here. $60,000 dropped to $57,204. That is a fact. $60,000 stayed at $60,000. NCUA, North National Credit Union Association, the credit union version of FDIC. $60,000 did not drop. It made you, we know for a fact, $1,370 in cash. $60,000, yes, it made you a little bit more in cash, $262. Wow. But for that, you lost almost $3,000. That's not a good risk reward. Don't do that, please. All right, so the next video I'm going to do is I'm going to show you what you should do with cash instead, because some people would just be content. I've seen this happen a million times in my 25-year career. I got $300,000 in cash. I was waiting for the interest rates to change. I didn't know what to do, blah, blah, blah. I'm going to show you what to do instead of that, because it starts to look, that's the opposite side. Like you're leaving money on the table by just not doing anything. Don't do that either. So stay tuned. Don't forget to subscribe. We'll see you next time. Thanks.